Hello and welcome to this latest Renegade Investor Report with me, Graham Rowan. And today I want to look at the American stock market, which by almost every conceivable measure appears to be enormously overvalued and potentially heading for a crash. But there are two sides to every argument. So I want to look at both sides of those arguments today, present it to you, and let you decide whether you think the US stock market is heading for a fall. Now, before we get into the meat of it, I just want to remind you that Renegade Investor Report is brought to you by Beaufort Society, which is the UK's leading private members club for sophisticated and high net worth investors. You can learn more about them at beaufortsociety.com, and also by Crypto for Grown-ups, which is a program designed to help kind of the over 40s, the more mature and serious and savvy investors to get their head around this whole new crypto space and see whether that's something they want to participate in. And you can learn more about that at cryptoforgrownups.co.uk. So the topic for today is the US stock market heading for a fall. Well, let me just give you a few basic facts to start with. The S&P 500 is up in 12 of the last 13 years, which must make this one of the longest bull markets in history. And that includes a 100% rise in the 15 months since what started last March. So it's been absolutely on a tear. And it's now the most expensive it's been at any time other than during the dot-com bubble. However, after 227 days with no significant pullbacks, we finally had a 5% pullback at the end of September. So is this the start of a bigger trend, or is it a minor blip in a continuing raging bull market? Well, one of the people that we tend to look to for guidance on these things is the legendary world's greatest investor, Warren Buffett. And he has his own little indicator, which is really flashing red at the moment. And this is where he takes the Wilshire 5000 index, which is regarded as a broader view of the stock market than just, say, the Dow Jones 30 or the S&P 500. And he divides that by American gross domestic product, the size of the American economy. And at the moment, the market value of the US stock market is about $53 trillion, while America's GDP is just under $23 trillion. So if you take that indicator, 53 divided by 22.9 to be precise, is 232%. And it was only 159% just before the dot-com crash. So we are way above the levels that we were at on the Buffett indicator. And the other side of the coin of this Buffett indicator is that when you're at levels like this, it implies negative returns of minus 3.3%, including dividends, for the foreseeable future from the American stock market. So it's very highly valued. The Buffett indicator is saying not only is it way overvalued, but we should expect negative returns from the market over certainly the next 3, 4, 5 years, based on where it's at today as a proportion of relative to America's gross domestic product. And arguably this is kind of emphasizing a trend that we've all spotted in the last 18 months, which is that the stock markets are completely detached from the real economy. Look how they bounced back so quickly after last March, even while businesses were closing left, right, and center, jobs were being lost in their millions, governments were going into printing funny money to try and keep everything going, and yet the stock markets went on a tear. So, this obviously is further evidence through the Buffett indicator that there's this massive disconnect between the real economy and the GDP we're seeing there versus the value, or the implied value, the paper value of all the companies in the American stock market. Now, historically, one of the best ways of measuring the status of the market and whether it was kind of fair value or not is the Schaeffer PE ratio. And this measures price earnings of shares, but over a 10-year period rather than just in the current period. So it kind of smooths them out and gives us a more balanced and more historical perspective. But as you can see, there have been occasions when it's been higher than it is today, but not very many. It's currently at around 38 times, so a price earnings of 38, which would imply it would take 38 years to get your investment back on the stock market if you bought it at these levels. Now, the absolute peak was 44 times, and that was just before the dot-com bust in 2000. I remember it well. That's where my wealth managers lost me about £160,000 in 18 months. And as you can see, when we've got to these dizzy heights in the past, here's Wall Street crash of 1929. Here's another crash in the 30s. Here's the 1966 crash. Look what's happened after reaching those levels. It's been a horror show. Particularly bad, obviously, after the dot-com crash. We've also had the 2009 crash. You can see they're down 54%. And then, since then, we've been on a tear for 11, 12, 13 years now. It's just been up, 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 up. And, of course, massively supported by the Fed's money printing policies. But historically, if the Schaeffer PE is over 25, that's usually been a precursor to a significant market pullback. So, this is a Sundial Capital Researchers view of what's where we are at the moment. And clearly, as you can see, we've got the kind of blue line representing the overvalued level. So anything above here, they see as being overvalued, and anything below the 10 mark, the orange line, and it's not been there very often, that's when it's been undervalued. So, even after the dot-com correction, it never got to the point technically under this measure where it would be undervalued, although it did after the financial crisis of 2008-9. But as you can see, you'd have to have timed your market bottoms pretty well if you were going to get the big boost upwards that came from those undervalued periods. And there's been a lot of data going back, best part of a century now, showing that from these kind of levels, the only way is down. Here's another way of looking at it without quite so much of a busy chart. And again, you can see the big peaks just around the turn of the century, 1929, 1966, just before the summer of love, and then the new millennium. And each time, look at what has happened. It has been a catastrophic fall, not just a minor correction. It's been a catastrophic fall. So, you are here. Where do you think it's going? Is it going to come all the way up here and make new highs above where it reached in 2000? Or is it going to say, look, I'm already ahead of 1929 and 1966 and 1901. It's time for a major pullback as we head through the 2020s. That's the question that we as investors have got to answer when it comes to looking at how much of our net worth we want to allocate to particularly the American stock market. What we're seeing at the moment is that valuations of shares are at 10-year highs, but dividends, yields, the earnings from these shares are now at 10-year lows. So you've got to pay more for the stock market than you have in the last decade, but you're going to be rewarded with lower earnings. Obviously, as the price earnings ratio goes up, that implies earnings are getting lower while prices are getting higher. So again, if you're somebody looking for yield, you're looking for income, part of the challenge of all this, of course, is that investors are being driven to the stock market, which traditionally has been regarded as higher risk than government bonds, because the yields on government bonds have become virtually zero or even negative. And why has that happened? Because the central banks, particularly the Fed, has been buying them with the funny money to actually support and monetize government debt. They are funding government programs by buying government bonds, and they're a kind of buyer of last resort. So they just keep on buying. And the more they buy, the more they keep the pressure on the yields down. So remember, with bonds, they pay a fixed amount of money each year. So the higher price you pay for them in percentage terms, the lower the yield is that you're actually getting. And so we have this heavily manipulated bond market where central banks, for broadly political reasons, are buying up any treasuries they can, suppressing the yields, forcing you and I as investors looking for yield to go into riskier things like the stock market, where normally you'd expect to get a premium because you're taking a bigger risk on these private companies than you are on the government. But because the private company, because we're all piling into it and we're all doing the same, the prices of the shares are going up and the dividends as a proportion of that are going down. So that's where we are today, with 10-year highs in valuations and 10-year lows in the actual dividends being paid. Another measure of this is called Tobins Q. Now, this is the ratio of share prices to the net worth of companies. In other words, the value of their capital stock and their other assets. And it's named after Tobin, who was a Nobel laureate who described it at the beginning of the 1970s. And the latest figures from the Federal Reserve are saying that certainly for non-financial companies, this ratio is over 165%. Now, that's twice the average since data began being measured like this in 1952, and it's the second highest level ever, just like the Schaeffer PE. So the only time it's been higher is just before the dot-com crash of 2000. So it's also sometimes used as a measure of equity valuations. So, it's been quite a good predictor of bull and bear markets. So it was very high in 1969, it was very high in 2000, and the S&P 500 fell in subsequent years. It was low in the early 80s and low in 2009, and that was followed by high returns from equities. So are we in a point of kind of irrational exuberance now that Tobin's Q is so high, second highest it's ever been? You might think that's a sell signal, but it's also possible that, it's simply that investors are discounting future profits at a very low rate, which is kind of the risk-free rate and the equity premium. So maybe in this low interest rate environment, in this low bond yield environment, people are expecting less from shares. They're expecting and willing to take, if you like, a higher risk for a lower return, and therefore they're not as worried as they might have been in previous periods when there were better returns available from other things like bonds. So has our own thinking, our own psychology, our own mindset changed, and therefore we're, if you like, justifying this higher Tobin Q ratio. What it's done is it has actually trended upwards right back since the 1990s. As bond yields have been coming down for decades, Tobin's Q, as you can see, has been going up. So it is a long-term trend. And also it perhaps reflects the fact that companies these days have got more in the way of intangible assets. If you're trying to value a company like Facebook, or even to some extent perhaps Tesla, there's not always, it's not just plant and machinery and factories and buildings. There's a massive amount of intellectual property that's been developed, software, algorithms, robotic capability, artificial intelligence. These things are much harder to measure, come and kick, to get some guy to come round with a, Rick's value or something and say, well, what's this company worth? You might just say, well, you got a couple of laptops here and you've got a couple of desks, but the brains that have driven those laptops and the things they've developed on those laptops could be worth billions. And we've seen countless times in recent years, it's things like fintech companies that have very little in the way of tangible assets. They certainly don't have a network of expensive branches to maintain like the high street banks, but they've developed capabilities that are revolutionizing the financial world, but it's all software, it's intellectual property. And those companies are being seen to be worth billions of dollars because of the value, because of the network effects, because of their scale, because they have low overheads and infinite scalability. Those companies can become enormously profitable. So in some ways, some of these measures perhaps are simply outdated and are no longer helping us as investors to make the right kind of decisions on where we're going to place our money. Now, JP Morgan have come up with some interesting charts recently to try and look at the different valuation measures. This is quite a complex chart. There's quite a lot to try and read on it. So it's looking at things like the price earnings ratio, and it's saying that at the moment it's around 21. Its average over 25 years has been around 16, 16.7. So they would see that as currently being overvalued. Again, using Shiller's PE, we said it's currently 38. The 25-year average is 27. So again, we're well above the average of the last 25 years. They also look at dividend yields. The average, it's never been great in the American stock market. They've never been such good dividend payers as, say, some of the British oil companies and so on, or tobacco companies. Average for the last 25 years in the S&P has been just a tad over 2%. We're now down to 1.43%, which of course is way below even the government's massively manipulated CPI inflation figures, which in America are now around 5%. So if you're relying on the yield from your shares, you're losing at least 3.5% a year in real terms if you're invested in the American stock market. That's marginally less than if you're invested in some government bonds, but it's still a guaranteed loss in these inflationary times. And even if they were to meet their target of 2% inflation, which of course they try to by just simply taking out anything from the measurement basket that might be going up in price, then you're still losing out even at 2%. But as you and I know, the stuff we're buying in the shops at the moment is going up by way more than 2, 3, 4, or 5%. I would say 10 to 20% has been more normal in the last few months. Huge debate going on about whether that's a transitory thing as we come out of lockdown and as we try and rebuild global supply chains, but it's starting to hang around rather too long for transient inflation for my liking. Price to book ratio historically has been about 3 times. It's now 4.23, and the price to cash flow historically around 10 is now 16. So pretty much every measure that JP Morgan are looking at is saying that the S&P 500 is currently overvalued, and in some cases significantly overvalued, as you can see from this chart, which is showing a standard deviation below, a standard deviation above the 25-year average, and we are above the standard deviation above the 25-year average. So again, I'm sure Warren Buffett would agree that one is flashing, if not red, certainly double or triple amber. Here's another way of looking at it. This is earnings. Now, this is fascinating because what you may have noticed is in the current earnings season is that certainly for a lot of the technology companies, they are having unprecedented record profits and earnings. And in fact, the earnings have gone up so much that recently the price earnings ratio has actually come down. That red asterisk there was saying that the multiples expansion of minus 7.1%. What that means is, look at how earnings and predicted earnings are skyrocketing. They're actually going up faster than prices at the moment. So for the first time in a while, the price earnings ratio has actually been moderated somewhat because the price has not yet gone up enough to reflect the massive hike in earnings. Now, of course, the 64 trillion, quintillion, whatever the latest measure is, dollar question is that level of earnings sustainable? Is this peak earnings? Have we reached the top? Or somehow, are they going to find a way of increasing those earnings? Well, I have to doubt that, because the situation in the employment market is such that people are recognizing now that prices are going up in the shops. Up to now, a lot of the funny money has just gone into asset prices like property and art and classic cars and so on. But what we're now seeing is it's going up in the prices of food in the shops. It's going up in the prices of petrol, if you can actually get any petrol. It's going up in the prices. Look at the energy crisis we're going through with gas prices, particularly, and also electricity prices. So, we've got an energy crisis going on. We've got food prices in the shops going up. There are some countries where that's leading to riots in the streets. This is always the first thing to trigger social unrest, is when wages don't keep up with with the most basic stuff that we need to buy, that's when people who are a bit less stoic than us Brits take to the streets to start complaining about it. And that's what we're now seeing. But the question is this transitory inflation? Are these earnings an aberration because everyone's been at home using Zoom and Netflix and whatever else, Facebook? Will they be sustained, or will there be a collapse in earnings that potentially could also trigger a collapse in stock prices as we head into 2022? The other thing that I think is really important to recognize is everyone keeps talking about the S&P 500, but really it is a very concentrated share index. And you could almost call it the S&P 5, because if you look at the impact of Apple, Microsoft, Amazon, Google, and Facebook, they are now collectively worth more than 9 trillion. Whereas, a decade ago when Facebook first went public, these companies between them were worth 1 trillion. So they've gone up 900% in a decade. And that's partly through network effect. It's through their monopoly positions in their markets. It's through very high earnings and an enormous global adoption of these technologies. But if you're a passive investor buying the index, it should get your attention that 5, maybe 10 stocks, if we broaden it out slightly, absolutely dominate that index, to the point where your earnings, and certainly your capital growth in terms of the share prices going up, rely on that same handful of companies having another decade to match the incredible decade they've had in the last one. So they've gone up 900%, give or take, in a decade. The decision that we have to kind of make now is, will those same companies go up another 900% in the 2020s? Are things so great for them? Are they so dominant in their markets? Do they have such what Warren Buffett would call a moat around them, that they will stave off the competition or keep acquiring them as people like Google and Facebook do? Or will other competitors come forward that will take their place? Because one of the things that we suffer most from as investors is recency bias. And we tend to think that what's happened in the last few years will go on happening ad infinitum. But the lessons of history tell us that simply isn't true. Even just looking back at some of the companies that were big a decade ago or 2 decades ago. I used to work in the telecom sector, and some of the biggest companies in the world were people like Nortel and Ericsson and Nokia. Where are they now? They are nowhere in global scale compared to these guys. Some of you may be old enough to remember the Nifty 50 from the 1960s. And the Nifty 50 was supposed to be the great companies that were going to take us all into this brave new future and make us a fortune. There's hardly any of them left. They all just disappear into the ether. I think the only company on the American stock market that's been around 100 years is General Electric, that can trace its origins all the way back to Thomas Edison. But it's been through all kinds of restructurings and near-death experiences in that time. So we have to be very cautious of the concentration levels in these small number of companies in the S&P 500, because the top 10 in that index make up 1/3 of the market value and 1/3 of the earnings. So as you can see on the right here, you've got 28.9% of the total value, so give or take 1/3, and 33% exactly of the earnings. And that's the top 10 companies. So this really is, in some ways, certainly the S&P 50 rather than the S&P 500. There are an awful lot of very low performing companies in the S&P 500, but the rising tide of the top 10 or 20 is lifting all boats and giving the appearance of a very buoyant stock market, when in reality it's very concentrated, and there are quite a lot of zombie companies at the lower levels, and there are certainly You need to really, I think, start looking at being a stock picker in that market rather than just what's been the trend in the last 10 years, the passive investing, buy the index, whatever. It's served people very well because of the driving force of these companies. But the question we have to ask now is, will it continue to serve us well in the next 10 years? And this is an interesting chart to show this value dispersal. You see that the green line is this kind of median, and that's where the average PE is 19.1. So you got 19 times earnings. But look at the depth of the gray either side of that average. There's a lot of companies above it. There's a lot of companies below it. So in other words, when you're buying the S&P 500, you are buying this average, but like many averages, it can be enormously deceptive. It's like, the average house price, the average rise in property prices. It disguises thousands of localized markets, just like this disguises 500 different companies, some of which are doing unbelievably well, some of which are literally barely making payroll and barely covering their interest payments. So, that's what you're buying if you just buy the whole index. An awful lot of underperformance matched with and lifted by highly selective overperformance from the ones that are way above average. The question then is, how long can that outperformance of the small number that are leading the S&P 500, how long can that keep carrying this index for as we move through the 2020s? That's one of the fundamental questions we have to ask ourselves. I want to read a new statement from Deutsche Bank that just came out, which certainly leaves no doubt as to where they stand on this. They say that US stocks are priced for perfection following a robust year of post-pandemic earnings growth, but high valuations suggest a sharp market sell-off could be imminent. On nearly every valuation metric, US stocks are trading at historically extreme levels. Trailing and forward price to earnings, enterprise value to EBITDA, and cash flow valuation metrics are well into the 90th percentile. In other words, they've only ever been a little bit higher than this in all of recorded history. Historical data shows that when valuations have reached such high levels in the past, 5-year forward returns were on average negative. Just like the Buffett indicator was telling us, Deutsche Bank's research is telling them that from these giddy heights, we're probably going to see negative returns over the next 5 years. And with expectations high for continued strong earnings growth, investors could soon be let down as results potentially disappoint. We are skeptical that the 85-year trend in earnings has changed. So that's a pretty significant and pretty unequivocal statement of where Deutsche Bank think the market is at the moment. And we could really ask ourselves whether the post-pandemic recovery is stalling, because certainly the most recent job figures in America have been very disappointing. They were expecting 733,000 new jobs in August. They only created about a third of that, 235,000. But yet there's 8.4 million unemployed in the US, but the number of job vacancies has never been higher. And we're seeing this happening in the UK as well. I was talking to one of our neighbours in an office in Richmond, and they said, we can't even get people to turn up for interview, let alone to actually stay here once we offer them the job. We've talked before about McDonald's paying people to turn up just for the interview. So there's a weird sense that people are not wanting to return to work. The workforce participation rate, as it's euphemistically called in America, has been around 61% and is falling. There's even a suggestion that it's falling because people have made so much money trading things like cryptos from their living room or their parents' basement the last 18 months. They don't need the money of going out to get $10 or $12 an hour on some minimum wage job. Of course, there's also the fear that those jobs may ultimately be replaced by automation anyway. But what we're seeing at the moment seems to be a reluctance among people to take the jobs that are on offer, but also the number of new jobs being created falling well short of what was expected. So are these the first signs of a kind of a spluttering recovery? Does this suggest maybe inflation will be transient because the economy is actually going to be coming in for a downturn? This is all to be revealed. So lots of arguments to suggest that we have a problem here. The market's overvalued by all traditional historic indicators. We should expect a fall anytime now. Certainly, I would think in 2022, we're going to see negative returns. We're already seeing below inflation yields from the market. So it's starting to look like a not very attractive place to either put new money or maybe even to keep money that you've already got in the US stock market. But there's always another side to the argument. And there are some very smart, very influential people saying this time it's different. Now, those have always been kind of famous last words as the ultimate kind of sell signal. But these guys are talking about something called the exponential age. You may recognize them. On the left, we've got Cathie Wood, who's the founder of ARK Invest, and on the right, Raoul Pal, who's a hugely successful money manager and financial trader, now runs the Real Vision platform and also provides research on the macroeconomic situation. And these guys are saying, no, you don't understand. What's happening now is a once in centuries kind of change. They're perhaps likening it to the Industrial Revolution. What we're seeing is the convergence of so many new and complementary technologies that we haven't even begun to understand the value of some of these companies. Cathie's unique, I think, in the sort of hedge fund and money management world of publishing all of her research free of charge. You have to pay a fortune if you want Raoul's research. I think it's about 40,000 a year or something. But this is one of the pieces of research that Cathie's team unleashed earlier this year, Big Ideas 2021. And these are some of the trends they see in technology that are going to drive forward the valuation of these companies, change our lives in the way that we adopt these technologies, and therefore have enormous value through adoption, scale, network effects, and so on. So they talk about things like deep learning, a whole new approach to data centers. Obviously, the amount of data being created these days is gargantuan compared to even just 5 years ago. So a whole new approach to how that is stored and secured is needed. And Lord knows we've seen plenty of data breaches all the way up to government level in recent years. It's actually becoming a new form of warfare, which is also, I think, touched on somewhere here with developments in cyber technology. Virtual worlds, you've heard Dee Ludlow and I talk about the metaverse on the Crypto for Grown-Ups program. There's a whole new world coming that we are, just really in the very early stages. Mark Zuckerberg at Facebook has got thousands of people working on this, and you're going to see not just wearing these clunky kind of headsets. It's going to become a lot more integrated into our everyday lives than that. And it really is one of those things that's limited only by your imagination. Digital wallets and the creation of the holding of money outside of the current financial system. That there is a real revolution going on in finance. The ability to bring in millions of unbanked people, the ability to send money around the world instantly without intermediaries and almost free. These things are going to totally disintermediate the banks, for example, and they are bricking it at the moment, worrying about it. These guys tend to be very keen on Bitcoin and the cryptocurrencies. The institutions are starting to come on board, which is going to bring potentially a whole wall of money. We're expecting the first exchange traded funds to launch in America soon. That will bring pension fund type money into the crypto world. So they're very bullish on those developments. Electric vehicles, I'm personally got very mixed feelings about electric vehicles. Everyone's been very smug at the moment saying, I can plug my car in, you can't go and you have to go and queue for petrol. But, hey, if you look at the energy crisis going on, there'll be power cuts soon. We'll be back to having candles in the home. So if we all had our Teslas right now, there's no way that the grid could cope with it. So again, it's all very well having the political will there and demonizing petrol cars, but at the moment, we probably still need coal-fired power stations. We certainly need more nuclear power stations. This ain't all going to happen through wind energy because, as we've seen, sometimes the wind doesn't cooperate, and you end up having to buy more and more gas through that pipeline from that nice guy over there in Russia. automation of anything and everything, autonomous driving, delivery drones, aerospace. We're going to be supersonic flights. If we ever get to flying again, we can go around the world in a few hours. We kind of gone down a cul-de-sac since Concorde, haven't we? There used to be a time in the 1970s you could fly across to America in 2 hours. David Frost doing TV programs on both sides of the Atlantic every weekend. You couldn't do that today. That's how backwards we've gone in terms of transportation. Yet now, new kinds of almost space travel flight and supersonic flight will get us there back to where we were in the 1970s. 3D printing, obviously, developing all the time, and all kinds of other technologies. Health screening, personalized health screening. So Kathy's argument is the combination of all these technologies happening at once: AI, robotics, electric vehicles, autonomous vehicles, space travel, all of that means that we are in an exponential age and huge value is going to be added. Meanwhile, Raoul Pal, is saying he's all in on things like Bitcoin and Ethereum. He sees this very much as an exponential age and thinks that all the old valuation metrics are going to be effectively proved to be just that, out of date. So he could be right. Kathy could be right. What we have to decide is, where do we put our money? And that's the dilemma we face, I think, increasingly in the 2020s. I keep referring to this as the age of uncertainty, and I think it's no longer possible to just follow old models like 60% equities and 40% bonds and assume it's all going to be okay. I think more than ever now, we need to be really well informed. We need to be taking a bunch of different inputs from people that we respect and then forming our own view on what we're going to do about it. So which side are you on? It's a bubble that's overdue a crash. No, it's not. This time it's different. We're living in the exponential age. That's the debate we need to have with ourselves or with our partners or whoever we decide these things with, our financial advisors perhaps. That could be an interesting one to get their perspective on this. What do you think? I've shown you some of the metrics. I've shown you what some of the people think. You've got to form an opinion yourself. And ultimately, it all comes down to asset allocation, because you can take an either or view, you can take a both and view. But ultimately, the question you do have to answer is, what percentage of your investment portfolio are you going to put or leave into the US stock market in 2022? There are other stock markets that look a lot cheaper. The UK stock market. Now, is it cheap for a reason? Because we haven't got any of these big tech companies? Have we got kind of oldie worldy companies, the oil companies and tobacco companies, and we just don't have the drivers of growth that you see in the American market? That's a fair argument, but equally, we tend to have stronger dividend payers. So if you're looking for yield, if you're looking for income from a stock market, you're probably going to get more in the UK than you would in America. And there are still advocates for the Japanese market, which, if nothing else, shows you how long a down market can last for. And again, this is where recency bias can influence us badly. When these markets go down, they can stay down for decades. You might not live to see the next recovery after the next crash. Some of the things that happened in 1966 didn't get put right until the 1980s. Some of the things in the late 1920s wait until the 1940s. It can take years for these markets to recover. Japan has been gradually improving. Its corporate governance has improved. It's even started to pay some dividends, and it has been traditionally, historically undervalued. So maybe it's still worth a look. What about bonds? I mean, are they worth being in any portfolio at the moment? One of the things I do worry about is some corporate bonds, which are not offering anything like the risk premium I would expect compared to, say, government bonds. And as the treasuries have been bought by the central banks, they've dragged down the yield on corporate bonds. But ultimately, who's buying these bonds? Because the Fed and the Bank of Switzerland owns half the Swiss bond and stock market. So all these markets are being manipulated by central banks. I'm not aware of any bonds that are looking attractive at the moment. Cryptos. I would argue that crypto should be part of anyone's investment portfolio. You just have to decide at what level. Personally, I'm looking at 10%. Some people might think 2%, 3%, 5%. I think it would be crazy to have no exposure to that market whatsoever, given what Raoul Pal calls the asymmetric risk. In other words, the upside is so much greater than the downside, especially if you learn a bit about the market and you know which ones to focus on and which ones to ignore. I think people would be crazy. And at the moment, people in their 50s and 60s are totally ignoring this market, this asset class. That's why I'm running a program to try and educate and encourage them, because I really do think you need some exposure to it. But again, it comes down to asset allocation. Where's property going in the rest of this decade? There are lots of things that could trigger a correction in the property market. Obviously, very much driven by interest rates. As the tapering starts, as they gently and gingerly start to raise interest rates over the next couple of years, what's the impact of that going to be on property? And already I'm hearing stories that some of the mortgage offers are reducing. We had that boost in the UK caused by the stamp duty holiday, and also by this kind of post-pandemic, I want more space, I want to be out in the country kind of thing. How will that go as people start going back to the office and so on? So property has got to be a question mark about where that's going. But again, what's your allocation to it? Precious metals, gold and silver, have not been doing what I would have expected at the moment. But if there was to be a crash, then they can be a good friend, both in times of inflation and deflation. So do you have a proportion of your wealth in precious metals? Maybe at a time like this, when all the traditional asset classes are not looking too healthy, you look at focusing on wealth creation through business opportunities. And there are plenty coming out the other end of all this. There are well-known and established businesses that can be acquired very cheaply at the moment. There are whole new ideas for location independent businesses that can be run anywhere you've got an internet connection. So maybe it's the time to focus on that and create some wealth that you can then deploy into these other assets as you build that value. And finally, collectibles. The funny money has been going into real hard assets. So if you do own art, if you do own property, if you do own other assets, collectibles like classic cars and so on, you might well see them going up in value as the funny money continues, as they print 10, 12, 15% more currency each year. Then just to stand still, those kind of hard assets need to be going up at that sort of level. And of course, wages are not going up at that sort of level. So again, we're going to see this disparity between incomes and affordability of these assets, which means, again, that I think people will be going more and more down the risk end of the spectrum, which could put them into things like stocks and shares, or even into cryptos, to try and get ahead of inflation and ahead of currency debasement in the coming years. So in conclusion, there are no certain answers to these valuation questions. I've shown you the metrics, but hey, there's an old saying that markets can stay irrational longer than you can stay solvent. So do you keep on riding the gravy train, hoping it's going to keep rising? Do you take some profits now, thinking there might be a fall? Market timing is always so difficult. But if you look historically across the 100 years I've shown you, you can see that we must be closer to the top than the bottom. You kind of feel that it wouldn't take much of a black swan event to trigger some kind of significant correction. I'm getting used to 20% swings in the crypto world, so maybe I'm a bit inured to what this would be like in the stock market. But are we really at a bubble at the moment? I mean, some of the measures I would use, like, is your taxi driver giving you stock tips, or your hairdresser? No, not hearing any of that at the moment. Does it feel like hysteria in the marketplace? The only time I would have said that was maybe earlier this year with the Reddit GameStop brigade. That was a whole new bunch of people coming in, almost gamifying stock market investing. That's still there, though it has kind of calmed down a little bit. And even people like Robinhood now are starting to get into the crypto world. So we could well see some of that money and some of that stimmy check and all the rest of it heading into the crypto world through platforms like Robinhood. So not all S&P stocks are created equal. It's really important to know that there's a very big concentration in a small number of companies, and history tells us they don't last forever. Even the ones you think are currently impenetrable, like Google and Facebook, will they be around in 10, 20, 30 years' time? certainly not in their current form. They may form part of some new agglomeration, but history tells us they won't be around for long. And the other question I want to leave you with is, we've come through a decade where passive investing in the indices was probably going to get you a better return overall than trying to do it yourself or trusting the fund managers and paying their fees. I'm not so sure that's going to work in the 2020s. I think there are going to be individual companies that do really well. I think there are going to be whole swathes of companies that struggle, and that's going to drag down the indices, which will mean it's much harder to get a decent return from pure passive index investing. I think there's no choice but to take control, become the orchestra leader of your investment portfolio, and spend time learning what's going on and making more informed decisions than you had to in the 2010s, let's just say. So I think this is a really important decade for getting on top of your finances, investing time in learning and education, finding some trusted sources of information, and then making more selective decisions on your asset allocation based on that newfound knowledge and understanding. Thank you very much for watching. I look forward to talking to you again on next week's Renegade Investor Report. I'll see you soon. Bye for now.